Business Weekly, brought to you by National Social Security Fund. NSSF, we secure your future.
Ahead on this week's edition, we look at the central bank rate cuts effected by the Monetary Policy Committee. And we also talk to Habil Olaka, the Chief Executive Officer at the Kenya Bankers Association. That's on the executive wing. Remember that you can send in your questions, observations or comments to the SMS number 8041 or email address ktnbizweekly@standardmedia.co.ke. Good evening and welcome to this edition of KTN Business Weekly. I'm Michael Oyer. Last week, the Central Bank's Monetary Policy Committee effected a 150 basis point cut in the central bank rate. And while many had expected the regulator to effect a rate cut in respect to trends in the prevailing indicators of a slower inflation rate and relative currency stability, the element of surprise was in the size of the rate cut. Just what are the effects of the CBR rate being cut on borrowers and on the general economy?
The best way to run banking industry is to ensure that there is a ceiling on interest rates charged. And we think this is best for the Kenyans who are borrowing money. This is best for the Kenyans who want to save money.
These are the kind of emotions that have been evoked by a sustained season of high interest rates regime in Kenya, attributed to a period of undeterred currency volatility that saw the local unit trade to record levels of up to 107 to the dollar, coupled by untamable inflation index as the country reeled under the effects of erratic global economic trends. And while local leaders sought to introduce legislation that will put a cap on interest rates chargeable by commercial banks, the central bank came under fire for maintaining a tight monetary stance. On the 5th of July 2012, in its monthly sittings, the central bank's Monetary Policy Committee effected a 150 basis points cut in the central bank rate. And while many analysts had expected the regulator to effect a rate cut in respect to trends in the prevailing indicators of inflation rate and currency stability, the element of surprise was in the size of the rate cut.
If you've been tracking the news in the financial sector yesterday, so Barclays Bank brought down their rate by 1.5%. And Bank of Baroda today. So this is the trend that one expects to see. And it's good for borrowers, but in the long run, it's also good for the economy.
The immediate effect on the July 5th rate cut will be on borrowers who will now access credit more affordably, as commercial banks will be expected to effect similar downward review in their best lending rates.
The central bank rate, which we call the CBR, is a signaling rate. Is the rate at which the central bank signals to the commercial banks that it is time to increase the interest rates, or when the CBR goes up, and when it comes down, when they lower it, it sends the signal to those people lending, the commercial banks, that it is time to lower the lending rates. The central bank last week decided to lower the CBR, and the effect on that there are many effects, but the major ones are: first, it should send the signal to commercial banks that it is time to ease credit.
The net effect to the borrowers should be, in the end, that the price of credit or the interest rates charged on loans will be lower.
The country's month-on-month inflation slowed down from 12.22% on the month of May to 10.57% in June, edging closer to the government's target of a single-digit index of 9%. The local unit also maintained relative stability in the region of 84 to 86 to the dollar, perhaps suggesting that the 6-month-long tight monetary stance maintained by the central bank was finally bearing fruit.
What the Monetary Policy Committee has been saying all along is that they need to be satisfied that the threat of inflation has been brought to bear, number one. And number two, that there is no real threat that there could be a resurgence in oil prices.
As the country's middle class who can afford credit celebrate the new rates that have already been effected by a section of commercial banks, a majority of low-income earners and the country's poor make little sense of the CBK move as they continue to grapple with high costs of living, with the daily challenge of access to basic commodities as the consumer price index continues to soar despite a downward trend in the month-on-month inflation rate.
When we say inflation has come down, it might send a wrong signal that the cost of living has come down. Inflation is the change in the cost in the CPI. You take the CPI for this month, then you see the change from last year, and then that's how you get inflation. The general prices are still very high. There's no doubt about that, and that will be a negative on the economy.
Well, the reason inflation has been going down, if you look at the components that go into computing the consumer price inflation, is actually a drop in food. If you don't hear people protesting about the price of maize meal anymore, or vegetables and tomatoes and that sort of thing.
And while the effects of reduced rates are not immediate, especially to the country's poor, analysts are optimistic this will have a trickle-down effect if maintained.
By the CBR going down, what that means is that there'll be more economic activities in place, people will get jobs, and the purchasing power will increase, and with that they'll be better off than when the price, when prices keep on increasing. It's bad for the poor people. It's bad. High prices are bad for the poor.
We saw a bit of a drop in oil prices. All these things feed into the lower digits on month-on-month inflation. So, again, when you're talking about 2 percentage points drop in the CPI, it is not so huge that you feel it in your pocket. You need to at least double or triple that.
Currency stability is vital for any growing economy, and in the past 6 months, the Central Bank of Kenya has employed various measures to tame volatility of the shilling. Key among them has been the mopping up of money from the market through the use of repurchase agreements, popularly known as the repos market. And while the sustainability of such a move in the long term remains debatable, it is imperative that alternative ways of boosting the shilling's standing are explored, key among them being addressing Kenya's export sector.
Actually, the main drivers of inflation in this country is food and energy prices. Those are the main drivers. Food, I think we have a problem in this country. The cost of inputs is very high. The government is trying to subsidize the cost of food. And National Cereals and Produce Board is a really inefficient body which needs to be reformed.
We need also more foreign direct investment going into those areas. You just can't rely on government or county government or local corporations. Or local corporations will make a contribution, but we also need more foreign direct investment coming into Kenya that will target those sectors.
Common to many developing economies, foreign assistance plays a critical role in meeting a country's budgetary shortfalls as well as boost its development expenditure, and Kenya is no exception. In the run to the Monetary Policy Committee sitting, the World Bank, through its lending arm, the IMF, had proposed that the Central Bank of Kenya maintains the central bank rate at 18%, perhaps fearing that the country was not out of the woodwork yet.
I think it came at the right time. The IMF's greatest fear was that inflation may still be a threat to growth in the country.
IMF just recommends to the central bank, to the government of Kenya, but the decision is made by the monetary policy of the committee of the central bank. When there's higher interest rate in Kenya, investors who want to invest in our treasury bills and treasury bonds are attracted to Kenya. Once you lower the yield on government security, then they become less attractive.
Going forward, the country is facing unique sets of challenges that include a huge import bill due to energy costs, an electioneering year that traditionally causes jitters especially to foreign investors, and erratic weather patterns that bedevil Kenya's agriculture sector that is rain-fed.
I think we are very optimistic, actually. The shilling has stabilized. The central bank now is more proactive and is on top of things. The fiscal policy, which we thought could be more politically influenced, the fiscal policy is very responsible. Our debt to GDP has reduced from 48 point something to around 45, 46%.
Well, one of the things that is very likely to happen is the big spending for the election will probably take part about 6 months or so before. And we've got to get ready for that. There's going to be more liquidity in the market than there is now. And the tendency is to bid for certain goods and therefore an incentive for prices to go up.
The onus is now upon the central bank to keep a hawk eye on the market to safeguard the gains made so far.
Time for a break now, but when we return, we'll be talking to Habil Olaka, the Chief Executive Officer at the Kenya Bankers Association. He's our guest on the executive wing. Stay with KTN Business Weekly. Welcome back. Some banks have already effected a downward review of their base lending rates, as indicated by the recent central bank rate cuts. In this week's executive wing, Habil Olaka takes us through trends in the banking industry. He's the Chief Executive Officer at the Kenya Bankers Association.
Now, in this week's executive wing, we look at the MPC's action to effect a CBR rate by 150 basis points. Just what does this action mean to you, the borrower, and to the banks that lend? And this week, we're joined by the Chief Executive Officer at the Kenya Bankers Association, Habil Olaka, to make sense of the situation. Welcome to the show. Now, 150 basis points. What impact is this likely to have?
I think the first impact would be the expectation that the rates in the market, especially the lending rates, would start coming down. And indeed, that is the consumer's expectation. And we are seeing already the market is beginning to move, and we have seen some rates by some specific banks coming down. So it's moving in the direction in which the consumer expected. Yeah.
Just before the action by the MPC, IMF came and said that maybe we should have held the rate at 18 for much longer. From where you sit, do you see that what informed the action was sufficient, or we should have held it much longer?
The good thing about the decisions that are taken by the MPC is they disclose the rationale behind the decision that was taken. And if you move a little bit back to the May decision, where despite the improvement in a number of the macroeconomic parameters, they still decided to hold onto the CBR at 18%. And I think one of the main thing was the fact that the non-food, non-fuel inflation had actually shot up as opposed to coming down, because it had moved from I think a rate of about 9.8 as it was then in April, to about 10.26 or something like that. Now, and that was clearly a threat. So the parameters that were considered, or the information that was considered at the decision that was taken, you see there was quite a number of positive developments. Inflation, the overall inflation came down, and also the non-food, non-fuel inflation came down to something close to 9.31, which is getting closer to the short-term target of the government, which is 9%. And the fact that there had been stability in the exchange rate, it was fairly stable over the period, and the reserve position at the central bank was fairly strong, especially after the foreign currency loan came in. I think so. Most of the indicators were showing positive developments, and we therefore see. And also the other thing they look at is the risks that are posed by the environment. And I think from that, the risks were identified. They were not as strong, but they were still there. And on the balance of things, I think it was the right decision for the central bank to decide to move the CBR by 1.5%, 150 basis points.
Barclays Bank announced they had cut their rate by 1.5%. which was accepted well by the general population. Is this a trend that we are likely to see coming from commercial banks?
You see, one of the things is that even though we have got 43 members, we also have 43 competitors, and the competition is pretty fierce. Now, you cannot afford to remain up there in terms of the lending rate unless if you want to sacrifice your market share. And since these banks are in competition, the forces of competition will just bring the rates down. It has got to come to what you can sustain as a business. Otherwise, if you continue charging rates that are not for the purpose of sustaining your business, then you'll be knocked out of the market. And I think also the competitive forces is what you are seeing happening now. The rates in terms of the deposit rates have not come down yet, but the expectation is that the rates eventually are going to come down, whether it will take 3, 4 days, a week, 2 weeks, but the rates definitely are coming down. Now, me as a player in the market, I can make a decision and say that since I know the rates are going to come down, I can decide to reduce now, sacrifice a bit of margin now because my deposit rate is still up there, but I know it will definitely come down. So I sacrifice part of my margin today in order to get the market share. And so I now become the first one to reduce my lending rate. And the others will definitely follow because given the forces of competition, the others will want to take advantage as well. And so you get the whole market moving down in terms of slashing their lending rates.
Well, many thanks for having us. I've been speaking to Habil Olaka, who's the Chief Executive Officer at the Kenya Bankers Association, on the recent move by the MPC to cut the CBR rate by 1.15%, or just about 150 basis points. And now you know what impact it will have on you, the borrower, or the bank that is lending you the money. This has been the NSSF Business Weekly Executive Wing.
Onto the money markets, and the Kenya shilling is holding steady in the 83.90 to 84.05 range against the US dollar. Over the past days, it has been exchanging at an average of 83.95, while to the sterling pound, it's trading at a mean of 130.35 against the euro. The home unit is exchanging at 102.92, while closer home in South Africa, against the rand, it has weakened further to 10.22. That's all we had time for this Wednesday. Let's do it again next week. Remember that you can send in your comments or questions to the email address ktnbizweekly@standardmedia.co.ke and to the number 8041. From myself and the entire KTN Business Weekly team, thank you for watching. I'm Michael Oyer. Good night.
Business Weekly, brought to you by National Social Security Fund. NSSF, we secure your future.